Morning, everybody. Hi there, morning. My name's Colin White. I'm from Credit Connect Media. I'd like to welcome you all to the second Credit and Collections Technology Think Tank. We're bringing together credit and collections professionals today with looking at strategies and outcome. Obviously, you've got a lot to look at the moment with the cost of living, interest rates, energy bills, inflation, Ukraine war. Just seems endless. And then obviously we've got the autumn statement today, just to add to that, which we will put on the screens at lunchtime for you, for those who want to find out even more news. But today, obviously, we are looking at the various sessions. We're going to cover different areas around credit and collections. We'd like you to be involved on the Slido, so you can see on there, you can ask questions using the hashtag #CCTechThinkTank. Any social media comments or photos or questions we welcome, so please add those when you get a moment. As I mentioned about Slido, if you want to ask those questions anonymously, that'd be great. But if you want to also ask any questions via our roving mic today, then please feel free to do that as well. We want everybody involved with that as much as possible. But obviously I want to just mention people who helped make today's event possible. So that's obviously our sponsors, Allied International Credit, Call Miner, Data on Demand, Debtstream, Experian, Qualco, Receive and Telrock. If you get a moment today, please go and say hello to them, whether they're a speaker or in the exhibition hall. They make it possible. I think it's even more at the moment, as we know, to talk, not just about technology, but talking to each other. So please do that in the breaks. That would be great. And obviously, want to welcome everybody for coming to today's event. So we're going to start off in a minute with cost of living. The industry response, we've got various speakers from associations giving us their view on that. I've got a session on customer engagement. Just so you know, there's not a real break in between, so please don't leave the room at 11:30. Just stay in here. If you want to grab a really quick drink, there should be some drinks on the tables there. And then we'll run that till 12:30, and we'll put the autumn statement up on the screen so you can watch that. And then we'll have more to discuss off the back of that this afternoon, 1:45, looking at assessing affordability and then future credit and collections. But enough from me. I'm going to now hand over to our chair for the day, which is Chris Warburton from RO Strategy, and he's going to run the event for us. So Chris, over to you. There you are. Hided.
Thanks, Colin. So, as Colin said, so welcome everyone to the Technology Think Tank, the Credit Connect today. So I'm going to be the chair for the day. A little bit about my background. So I've spent the last sort of 20 years in risk operations, for those of you who don't know me. Really looking after processes across the customer life cycle throughout credit and collections. So currently director of RO Strategy, and one of the things I've also been doing is working on a series of videos looking at the impact of technology and some of the things that are happening that can really be innovation and technology to credit and collections processes. So we've got a fab event today. There's a lot going on. There's a lot going on in the world, but there's also, we've got the autumn statement obviously going on in the background as well, which I think is also going to be breaking news across this for those of you who aren't up on what's already been leaked. So, and we'll be talking a little bit about that. But the four sessions we've got really around, first one is talking around the cost of living and how as an industry we should be responding to that. Then we've got a session really around customer engagement, how do we get ahead of the curve in supporting customers. And then in the afternoon, we've got a session then really around assessing affordability, so credit and collections risk. Once the customers engage, how do we assess affordability in terms of lending, but then also in terms of collections. And then right at the end of the day, we've got a forward-looking view around what does the future of credit and collections kind of technology look like. And all of this is obviously before we go into the awards this evening for those of you who are staying, so that, I know that's going to be a great event as well. Like the session to be as interactive as possible. I know we'll take questions from the floor. There's also Slido that's available, so we'll be doing that throughout each of the sessions. So the first session, I'm going to bring up the speakers, is really around the cost of living response. And, obviously there's been a lot talked about cost of living. I was watching the news last night and there was, food inflation's at 16%, I think it is. Inflation's at 11%. This came out yesterday. Energy rates have been going up. That's sort of causing stress on people. And obviously the interest rate, Bank of England interest rate's now at 3%. It's putting a lot of sort of concerns, I think, in our industry around, people rolling off fixed rate mortgages, energy tax, tariffs and just general cost of living. So this session really is around what would the impact be for credit and collections, how should we respond to that as an industry, both in the credit side as well as also in the collection side. So the speakers we've got, should I get this right? So the speakers we've got for this session, we've got, I don't know if they want to come and join me on the stage. We've got Chris Leslie, who's the Chief CEO of the Credit Services Association, obviously National Trade Association for Debt Collections and the Debt Purchase Industry. We've got Anna Roughley, just joining us here, who's the Head of Insight at the Lending Standards Board, and they obviously provide independent oversight and fair customer outcomes within the financial services industry. Then we've got Andrea Cox from Experian, obviously, no introduction needed in terms of leading information services and credit bureau in the UK. And then we've got Faizan, who's the Senior Policy Manager for the FLA, Finance and Leasing Association, and they're obviously the industry and trade association for asset, consumer and motor finance across the UK. So welcome everyone to the session. I suppose what we're going to do is go straight into questions as much as we possibly could. So there's been a lot of talk around the cost of living and cost of living increase. What do you think's the impact's been on your members and customers? And maybe Andrea, do you want to start with that? Because obviously you talk with a lot of your clients in terms of what they're kind of seeing.
Yeah, so we obviously at Experian, as you say, we've got a lot of data as well. So across the UK, we can look at what we're seeing as an impact of the cost of living. And the headline really is we're not seeing a massive impact at the moment on collections. We're not seeing a massive impact on new lending. And we are seeing some growth in sort of credit cards, but nowhere near still at the levels that they were pre-pandemic. So in reality, I don't think the storm has quite hit us. But we do believe that there is a lag. Because when we're talking, we talk a lot across multiple sectors, both lending, utilities, etc. And we are seeing a small increase in some sort of collections. Certainly in the utilities sector, there's a small increase. And that's a bit of a worry because utilities is seen as a priority payment. But also the concerns mainly that I'm listening to and talking to our clients about are what's going to come. So the mortgage shock is one of the key issues. There's a lot of concern around fixed rate mortgages and people coming off those terms. So at the moment, in conclusion, I would say we're not seeing a great deal of stress at the moment, but maybe this is the calm before the storm.
Yeah, so it seems like there's a lot of discussion that's taking place, but it hasn't necessarily translated through into what people are seeing on the ground. It's kind of what I'm hearing. Is it's like, yes. And we're waiting to see what's going to come through.
Yeah, we don't. So I don't think some of the impacts have really been seen. Like I say, when you're looking at an overall affordability of an individual, I don't think the price increases on utilities has really come through yet. I mean, obviously we saw the biggest increase in October. Yeah. I don't think that's had a massive impact yet on individual finances. But we are seeing so. We have unique access to obviously current accounts and savings within current accounts, and we are seeing a slight reduction in credit in those balances. Obviously, during COVID, many people were able to save more, and we could see that through that data. And what we're seeing now is that the people are eating into those reserves.
And Anna, we were chatting a little bit beforehand just around where you've got concerns in terms of like where it might be hitting us, in terms of like different segments of the market, given that we might not be seeing it yet, but what are you kind of hearing from your members?
Yeah, it's really interesting actually, because a lot of our registered firms and lenders and banks, etc., are saying something sort of similar, that we're not really seeing that challenge that we expected to see just yet. But interestingly, and I just want to jump off the back of a few things that you've just said, some of our other stakeholder engagement is telling us something quite different. And so what we do know is those people that were already on the line are, in some instances, in quite a desperate and sobering situation. And then what we're also hearing is an increase in calls to, say, advice centres, where customers are trying to find additional disposable income or disposable funds, essentially. And in some instances, something that hasn't been seen before, customers are being told that the only place they can find any additional money is to reduce the amount of money they're putting into their pension, which is actually, you know, no one would, that's quite a severe step to take, but that's the only place that they can find more money. And then just on that savings point as well, I think there's been some statistics published recently where more than half of UK households are saving less than they were, or are unable to save anything at all on a monthly basis. And so I think what we're starting to see is that those that were in a pretty bad situation before are in a really bad situation now, which is only worsening. But we're starting to see, particularly off the back of what the FCA have said as well, where customers aren't always engaging with their lender, creditors, to tell them that they're starting to feel the signs of stress. That feels true to me, that they're going to different organisations to try and work out how they can meet those commitments before it starts to go horribly wrong. So I think our focus is certainly in the pre-arrears space and identifying those customers and offering them the support that we can as soon as possible.
And Faizan, I was going to come to you just in terms of like from your sector, and particularly things like motor finance. So I've certainly seen in the US, there was I mean, this is the US, it was the change in the phone, pricing of used vehicles. Are we starting to see some of the same things happening here? I mean, what are some of the trends that you've been seeing with your members?
So it's a good question, and I think I mean, I agree with everything that's just been said, and I guess from our member perspective, it's been quite an interesting one because again, we aren't really seeing any sort of upticks in the sort of arrears levels or any sort of data that can suggest that there are some sort of stressful sort of situations. I think what we're seeing from members particularly is that sort of preparation for challenging times ahead. Some consumers may not necessarily be showing those signs, but I think firms are very aware of the risk and they are starting to sort of plan ahead for that. The data is an interesting one because I think it's starting to show some slowdown in some of the trends. I mean, some of our consumer finance data that's been recently published, particularly for the consumer finance market, is showing that there was, I think, about 14% or so growth in September last year. And this is now sort of, September this year, and this has now slowed down to about 4%. And it feels as though even with mortgages in the second charge mortgage sector, I think we'd seen in August this year about 37% or so or new business volume growth, and that's now sort of come down to about 29%. So again, there are some sort of changes in that. It shows that the growth is slowing down, but I think there's a slight lag in this data. But from a firm perspective, I think one of the key things that they're starting to think about is what does this mean for their sort of employees, for the labour market. It's showing that there is still some strength there. But essentially the emerging risk is, I think, low financial resilience. And essentially we've seen some data from the FCA recently in their Financial Lives survey, and they published this, I believe, in 2017 and 2020, and now 2022 in October. And I believe from that they are saying that there are about 1 in 4 people within the UK that essentially have low financial resilience. So these are people that are essentially going to be struggling with problem debt at some point. Yeah,
and the growth rate, are you seeing members or businesses in the industry sort of changing their cut-off scores in terms of, is that a response to it in terms of like just trying to manage the risk going forward, or do you think it's just natural uptake of people being worried?
Yeah, I think it's a bit of both, actually. It is, I mean, firms have been preparing for quite some time. I mean, with lots of regulation coming through, like the consumer duty, there's a lot of preparation that firms have been doing. And I think it's an interesting one because it feels as though we've just come out of the sort of COVID-19 pandemic, and now we're sort of going into this cost of living crisis. So in some ways, there's a silver lining that firms have actually prepared to some degree, and this preparation is now continuing. But it does feel like there is... likely to be some turbulent times ahead in terms of how credit risk is managed and what that looks like, and people that may normally be able to sort of get credit, whether they're now able to sort of obtain that credit in the future is probably a question as well. Yeah.
And I suppose, Chris, then just coming in terms of like the broadened collections kind of industry, in terms of, obviously, when it sounds like we're not hearing the arrears levels that, maybe we would think, and we certainly we talked about that at the start of the pandemic. It didn't come through because of a variety of reasons. I mean, what are some of your thoughts in terms of when you think that will come through, what the impact should be, will be, and what you're kind of hearing?
Yeah, I mean, it's always reassuring to be on a panel where we're sort of assessing this situation similarly, and I would agree with Andrea's initial assessment in terms of everybody's expecting the pending storm, tsunami, whatever you call it, around the corner, mostly 2023. I mean, don't forget, obviously, collections debt purchase is at the end of the chain anyway, and so there's always that time lag, although there are quite a few who deal in early arrears and are definitely reporting, even anecdotally, a little bit more pressure on settlements starting to emerge. It is quite a fascinating thing. I mean, obviously, none of this is going to be quite as turbulent as the pandemic. We're sort of in this period of time where, we're talking about quite a long but shallow recession, and so, is some of this even a psychological effect of people sort of, being, girding themselves just for potentially larger energy bills and almost having conversations perhaps that they wouldn't necessarily have done had they not got used to some of those conversations in the pandemic, for example. I would just sort of counsel, though, there are some glimmers of hope on the horizon, possibly. I don't want to overdo it, but we have quite high employment rates in the UK. I mean, unemployment hasn't yet really sort of tanked through the floor. And in terms of, distressed NPL side of things, I mean, that is actually quite a positive thing. In terms of the energy shock, it is going to be significant, but, if there was a bit of wood, I'd touch wood around here to say, actually, energy prices have been have been coming down a little bit more in sort of recent times. And you always have that imperative of government intervention as well. And we'll talk about that presumably in a bit too. But there's, for those who are in the most distressed sort of side of things, there will definitely be, because there's a political imperative to do it, some extra financial support that goes in there too. But no, the psychological effect is, I'm always having, I've started to have more arguments with my wife about turning the heating down more recently. And if I were to draw a graph about where that's going, definitely October, November, it's going to be the time when people are really, having these tussles about, shall I put the energy on or not? Yeah. People are very, very hyper aware of it. Well, certainly in my household they are.
Yeah. Well, I've noticed how hot the hotel feels. I have to say, because it's really warm. And I was going to ask you about the autumn statement. Obviously, we've got that coming on later on. We're going to have this on the screens, as Colin kind of said. But I'm interested, just particularly with your background, in terms of what do you think some of the things that are decision points are going on with government at the moment? I mean, through the pandemic, we were all expecting the world to fall apart, particularly in the collections world, and it kind of didn't, largely because of government intervention, right? So do you think we're going to kind of see the same kind of thing today? And I'm interested in what your kind of perspective is, given your background.
Well, I think, certainly Rishi Sunak would, if he could, do a big sort of wallop of government intervention. But of course they can't, because as we've just sort of seen, the gilt markets simply won't tolerate a massive expansion of government debt to pay for that. And so I think we are going to see, we pretty much read it in the papers overnight, the tax rises especially hitting middle and upper earners, and that targeted support for people on means-tested benefits, so there's supposedly going to be a £1,100 additional payment, which does have an effect. I think there'll be fingers crossed that the need for government energy price guarantee won't be there as much as everybody has sort of expected. But never underestimate the desperation of politicians when there's a looming general election to absolutely get themselves over the line. So they will do whatever they possibly can to ease what they perceive are the issues that are going to drain away from their electoral support. So actually, in timing terms, the level of support for the general public is probably going to be more than might otherwise have been the case if we'd have been a long way from a general election. As you get closer to it, there's much more likely to be that level of support. Yeah,
there was some talk about, I think I was reading the news this morning around things like social care cap, which can affect us being pushed out till after the election, and those kind of things. This is what's being sort of pre-led, isn't it?
There's a whole sort of separate depressing story about long-term is sacrificed in order to get through a short-term issue, but and a lot of it will be stealthy changes that people won't either understand or but they'll definitely feel it. We are going to see that tax burden issue has to be factored in also, because priority debts and all that. The government are very good at making sure that they are the first call for the consumer. So that will certainly if we get onto things like statutory debt repayment plan and SDRP and those kind of things, they've been very good in the design of that to make sure government gets taken first.
Yeah, I mean, I think it'd be quite interesting, and Anna, we were chatting a little bit earlier around, I suppose, where the help comes in, right? So you've got people who are in debt now and they're already behind now. There's things like social care will help with that, but you've got this new people into collections potentially that they could be impacted, and they could even be impacted by inflation. They'll be impacted by tax rises as well, and it'd be interesting just in terms of like where the help comes in terms of what that means for us and dynamics of an industry. I think.
Yeah, absolutely. So. Yeah, we've spoken about those that are already in need. And I think we have a really strong across the industry infrastructure to identify those, to offer the support that they need, whether that's with their lender, in collections, whether they go to debt advice. But I think really we're going to start to see a new cohort, if you like, of customer or an individual where financial difficulties has never been really a concern for them, perhaps. And this is a completely new area. And I'm calling it the creep at the moment, that I've sort of coined it this morning, because I think, you know, you've got some financial resilience, you know, people like myself, you know, you think we're okay, we earn enough money, but each one of those bills, those food bills, like you say, are starting to increase. And then if tax could impact you as well, increasing tax payments, that very quickly that creep will catch up, and suddenly I don't actually have that much or any disposable income anymore. And I think because you're in that, you feel like you're safe and secure, and that can quickly go away. So I think it's really critical, and something that we're talking a lot about at the Lending Standards Board at the moment is that focus in pre-arrears. So anyone that's signed up to our standards knows that in the personal space we have the money management standard, and in the business space it's credit monitoring, because I think we're good at the credit side of things, at looking at, you know, do we need to reduce or look at our affordability checks? Do we need to, you know, really be more stringent in that space? And when we get into collections, we've got some really good practices and support mechanisms in place, but really our focus should also be, particularly at this point, for those that are going to be impacted by the creep, that proactive forecasting. And I know you guys at Experian do some work on this, and some of our organisations work with you, but actually helping customers to see where and when they might be impacted based on what they can see is happening in their accounts. We want to see more in that, what we're calling prevention space, so preventing people from falling into financial difficulty through raising awareness of what their personal circumstance looks like. And if you can't prevent that from happening, then actually preventing the impact of it when it does. And so we really need to strengthen across all sectors, I think, that piece.
And Andrea, I was going to ask you next, just in terms of like being, so in the collections world, I mean, and it'd be good to talk a bit about the lending side of things as well, but in the collections world we tend to be quite sort of reactive rather than sort of being proactive. I know we try and be proactive, but it'd be good to, it feels like now's the time to be proactive, and it'd be good to sort of, what are some of the things that you're looking at in terms of, you know, trying to get, where should we be focused? Where should we be focused? We talked about pre-arrears, but...
So I agree. I think pre-arrears is really important. And one of the things, when you're looking at creditworthiness and affordability, it tends to be done at point of new lending, whether that's to existing customers or brand new customers. And also with the consumer duty that you mentioned earlier, that's just not good enough anymore. And so obviously what consumer duty is introducing is that continuous monitoring and assessment to identify vulnerable customers earlier. And certainly from my perspective, I can talk around identification of financial health and financial vulnerability. So that's something that we are focusing on at Experian, certainly, to look at real early indicators of someone, an individual, because this is really about individuals now, getting into financial stress. So identifying them before it becomes a problem. And we have a lot of data that we can use to assess that. And so that's what we're talking to actually quite a lot of lenders about at the moment. One, it's because it's a regulatory requirement that's coming in next year, but also because it impacts the provisioning of their existing book. It impacts their new lending. So it really is a shift that I haven't seen in all of the time that I've been working in affordability, to be honest. But it's certainly something that we're looking to address with lenders.
Yeah. And so do you think there's new data? Do we have to go to new data to find some of the pre-indicators, or do you think we've got a lot of what we need already and we just haven't interpreted it right?
So we have a lot of data already that can identify people who are getting into more difficulty. It's really around, but sometimes there's too much data as well. So it's working out, and this is what we're doing at the moment, working out which are the important data elements that are really truly showing when someone's getting into financial difficulty. And that's where we're trying to help is, you know, there's a lot of data points around people's finances. It's about making sure we get the right ones and can help the right individuals.
And how much, before we, because I want to talk about consumer duty, but how much do you think the pandemic sort of affected us in terms of almost like the fog of the pandemic, in terms of some of the historical indicators, in terms of what that means going forward, from at least from a bureau point of view? I mean, do you think that's it's okay? We can still use what we've got, or is it still having some lasting impact in terms of indicators for, particularly in terms of financial stress, because it was so different?
Well, obviously the pandemic had a massive impact on a lot of things. Like I said earlier, there was the ability for a lot of people to save. We weren't spending as much money, so people's disposable income wasn't impacted that much, and in fact they had greater ability to save. So if you're looking historically at that and using that on itself, then no, it's not a good period of time to actually look at any forward decision making. But what we're seeing is that people are looking pre-pandemic and post-pandemic as well, to look at that. But I think we've moved into a world that isn't just about what did someone do in the past, it's about what are they doing now, because we find ourselves in a very unique situation. You know, in the whole time that I've worked in affordability, I have never seen so much interest and importance placed on the expenditure element of the affordability calculation. And it's that's different now. Yeah. And so we have to look for new data, look for trends in previous data, and really help focus on truly understanding what an individual's non-discretionary expenditure is.
Yeah, yeah. And we talked a bit about consumer duty, and Faizan, I was going to come to you and ask a little bit about that in terms of consumer duty. Obviously, you know, that started now, implementation next year. We've gone through the first deadline. But I mean, what do you think the impact is going to be? And particularly, I mean, a lot of this, we've kind of, in some ways, we've had some of this already, but I mean, it does add an extra layer of sort of like regulatory oversight, etc. I mean, is it the right thing at the right time, or is it even a little bit too late?
It's a really good question. I mean, I think from what we're seeing, it feels like it is the right time. There are, I mean, as I sort of previously mentioned, firms are already starting to prepare for the worst. They have gone through a number of different sort of exercises just to ensure that, you know, they're doing the right thing to understand the changes in the customer circumstances. But there are regulatory burdens. I mean, you know, you clearly have the consumer duty. You've got Dear CEO letters that have come out recently. I think there's one for mainstream lenders. There's one at vulnerable customers and treating them fairly. And, you know, so there's all sorts. And then you've got the sort of borrowers in financial difficulty work that's also been published recently by the FCA. And that is, it feels as though they are sort of layering the consumer duty or applying some of the themes through that sort of, you know, project work that they've sort of carried out. But essentially, what does that mean for firms? I think it's just trying, you know, to ensure that they have all of the systems in place within the right timelines. As you've mentioned, you know, I think for existing accounts, you've got until next year in July to sort of implement. But it's looking at things like the customer journey, understanding, you know, how customers are engaged. There are lots of outcomes that the consumer duty sort of is sort of asking firms to sort of look at. But it's that customer understanding piece as well. And so I think there are lots of different strands to it. And I mean, in terms of the timing, I think it's better that firms have started earlier rather than later on when, you know, as we've said, it doesn't feel like the worst has come yet, but it could be the case. And I'm sorry to be very gloomy, but I think it is just something worth considering. It's good that firms are starting to look at this earlier. Yeah. So, Chris, I'm quite interested in, I know we were talking about it on the pre-call a little bit in terms of like the readiness, particularly in the collections industry, in terms of like, what do you kind of feel in terms of, I mean, the first deadline's passed, I suppose. I mean, how are people getting ready? Do you think it's going to be a big deal, or do you think we've got some of this stuff, some of the infrastructure in place already? Yeah, I mean, I think in our sector, the collections debt purchase sector, certainly at a strategic level, people are pretty aware of what's coming, and they get it and they understand it. Actually, they've been quite
good comparatively to other sort of corners of the financial services sector on treating customer fairly. Don't forget, our sector has, not just on the consumer credit side, at least the regulator, but has a lot of creditor customers further up the chain also coming along with clipboards constantly within the organisations and assessing what they're doing. So pretty well versed in sort of compliance challenges and how to deal with those. I mean, being honest about consumer duty, I still find it a little bit gelatinous. It's a little bit like pinning jelly to the wall. A lot of people find, you know, the hankering after rules rather than necessarily sort of principles that are, you know, a cynic would say this is an opportunity for the regulator to take a vast amount of potential power to then swoop in and regulate when in future they see issues that they can't yet predict come along, and that's undoubtedly what's going on. I think we're going to move to a time where it's going to be about training up and upskilling the frontline staff so that they're also familiar with what exactly the consumer duty means. But the slight anxiety I do have is that, certainly more on the creditor side, we're going to see so much anxiety about subprime lending that you see a retreat from credit availability into those parts that might have, you know, historically felt more, you know, more risky. And there's dangers to reducing credit availability in society. I mean, you know, sometimes we feel a little bit defensive about our sector. I personally believe that collections is absolutely integral to making sure that, in turn, creditors can have balance sheets that are healthier and are then able to lend out, and that has socially beneficial. You know, it's a good thing for society as a whole. And so I always think we need to make sure we say to regulators and government, you know, do have one eye on the impact collectively of regulation. You know, I mentioned SDRP before, for example, as another thing, but collectively, what is the impact of all this going to have on credit availability, particularly at a time when people are so stretched from getting from one payday to the next?
Yeah. I mean, it's almost like there's so much change going on, you're going to have almost like unintended consequences by being too tough in one spot rather than another if the system kind of changes. I was just looking through the questions here. There's a good question here, which is one of the questions I was going to ask in the future, which was around cost of living doesn't just obviously impact customers, but also impacts employees as well. And, you know, what do we need to think about that in terms of employees? Because they're obviously going to be having conversations with customers who are in stress, but they might also be, they're also being affected. We're all being affected by particularly food price increases. I mean, any thoughts on what we need to do for employees and sort of, you know, how we need to think about that? Anyone in the panel really?
Yeah, I'll take that to start. I think how we want our employees to treat our customers almost starts at home, doesn't it? So, you know, we think about culture and how we're looking after our employees for a start, and businesses are feeling the pinch, of course, and so we'll establish what that looks like in various different ways. But I think there's also something conversely, is that people are all impacted as they were with the pandemic and they are with the cost of living crisis in different ways, and so there shouldn't be an assumption, and it's unique, you said, Andrea, it's unique to the individual, and so there shouldn't be an assumption that just because everyone's aware that there is a cost of living crisis, that our employees understand how this might be impacting other people individually, and also how to handle that. And so one of the things that we're seeing that is working well or not very well when it's not implemented is firms should be reviewing the training that they deliver for their frontline employees when they are engaging with customers, and that should look at what are the impacts of the cost of living crisis, what might that look like to a customer, and how they need to engage with them, because your BAU, you know, your business as usual, financial difficulties training, for example, just isn't sufficient in a situation like this. So that should certainly be refreshed. And similarly, some of our employees may be quite vulnerable in certain circumstances, whether it's financially or vulnerable to a particular topic, and can be triggered in the same way that, for example, if a customer has experienced a bereavement, if your frontline employee has recently experienced a bereavement, they may not be the best placed to have that conversation with that person, because it can be quite triggering. We see examples of oversharing, for example, when we're trying to be empathetic, but it becomes too much. That can be distressing for the customer and for the employee. And so it's about, you know, back to that culture piece, is how are we looking after our employees? What have we got in place? Have we got a process for them to say, actually, I'm, you know, to stand up and say, I'm not I'm not the right person to deal with this customer right about now. And we're not expecting that to happen all of the time, but actually if they feel supported, then you're going to be able to support them better and to support your customers better.
Yeah, I was just going to say that we reckon there are about 11,000 staff employed in direct collections activity in one way or another across the sector in the UK. And, they often can be, sometimes working from home more than they perhaps used to be, but often in office environments, a young cohort often of employees. But despite the sort of myths and misconceptions that are there, they're a very professional, well-trained, well-skilled group of people. I mean, if you look at the complaints data, for example, compared to other bits of the financial services sector, FOS have uphold rate of 42% for complaints that come in about financial services more broadly. It's 27% uphold rate in collections sector. Still a long way to go, but actually we feel, relatively that the professionalism of the staff on the front line stands very well in comparison. We did some opinion poll work over the summer and asked sort of representative sample of the British public who had been contacted by collections agencies. What was your impact when you had those conversations? And a majority said it was good or excellent, which actually is counterintuitive to the story you might expect to come through. So, there are positive things going on amongst the staff and the teams, and they definitely need sometimes that appreciation, even if the financial reward is difficult to deliver in terms of pay increments and so forth. Just showing that appreciation for the work that they do in the sector and the value that they provide to the credit cycle more broadly is definitely worthwhile right now.
Yeah.
Can I just jump in there? Sorry, because I just wanted to corroborate that and also to say, please don't think that I'm saying that there are poor conversations happening out there, because obviously that happens, but I don't think there's any question over the professionalism of the employees. What I would caution against, and particularly actually just thinking about the consumer duty piece here, is that sometimes customers will have a really good experience with an agent, with an organisation, but that's why your customer journey reviews are really absolutely critical, because it's about the outcome that you're trying to achieve, and because a customer's had a good experience doesn't mean that the outcome was the right thing for them. However, having said that, and our role as a regulator is to say this is how you can build these better infrastructures, not that it's going wrong all of the time, but we do see really good, really empathetic conversations happening across the entire customer journey, banks, lenders and in the collection space. But I think we do need to think, for consumer duty and against this backdrop, we've got really good frameworks in place, but let's have a look at what we do already and what we can do better, because I think we can sharpen up on a lot of things that will help us to comply with the consumer duty. Because we really look at innovation's really important, but we can innovate with what we've already got, and that can be really a lot quicker to implement, and relying on your frontline staff as well to really feed into that process, is because they have real great insight that can make such a difference to the customer outcome.
I get frustrated because it just feels like the industry, sometimes there's a lot of sort of noise about it that isn't really fair, and we're going to be front and centre, particularly in the collections industry, around offering support for many, many customers, and there's been a lot of great work that's happened, I do think. But I mean, so the reality is that some of the agents, though, will also be under financial stress as well, and just making sure we're thinking about them, which I know the firms will do, but I think it was a very, very fair question. An interesting point you raised there, Anna, was around flexibility and process flexibility, and certainly through the pandemic, it felt like we had to have a lot of process flexibility. Maybe some of us didn't have it, right? Because we had to. It was a big lift to try and change processes. Do you think that's going to be important? I mean, are companies starting to build that in? I mean, how important do you think that's going to be? I mean, Faizan, maybe ask you on that question.
Yeah, I mean, I think it is really important. I think the thing is that you're in a situation now, or customers will be in situations where their circumstances are changing, perhaps even on a daily basis, not just monthly or yearly. And it's important for firms to be able to sort of understand what those changes are, and then be able to sort of adapt to those changes in a flexible way. You know, that means not just looking at what's already in your sort of forbearance toolkits, it's that sort of tailored support that's provided. And again, the FCA has, you know, during the pandemic published this tailored support guidance. It's now thinking about whether it's going to update that guidance and it may consult on that in a few months. And the question is, you know, does that then lead to some handbook changes and things like that? So I guess it's for firms to sort of preempt in what way can they support customers in those circumstances, because they're quite challenging and it's not always clear cut. Yeah. So it is a challenge. Just one other point I want to make slightly separately, just in some of the conversations we've been having with the Money and Pension Service, it again, just, you know, looking at that sort of financial resilience, what they're seeing is a slight spike in the number of people coming forward for seeking debt advice. And, you know, that is not quite at the sort of pre-pandemic 2019 sort of levels, but it's, you know, 1 million or so customers, give or take. And what they are saying, which is slightly alarming, is that about 50% of those people are those that may end up in budget deficits. And I think that's really sort of interesting sort of, you know, scenario when it could lead to some things. So I think, again, it just framing that into what firms will need to do to help tailor that support is
how ready do you think firms actually are? I mean, so obviously you've got the regulators making noise, you know, as an industry we're saying, well, we need to do it, but I mean, you know, is it translating to action on the floor? I mean, and is that everywhere, or is there there's still gaps there? I mean, do you think it's got the profile that it needs to have?
I think so. I mean, from what we're seeing, certainly from firms, it's positive strides. You know, they are trying to do the right thing. You can see that they are, especially when it comes to sort of understanding the regulation and understanding what their objectives are. They're certainly trying to sort of make that sort of adjustment. But I think it's things also like, you know, having more customer engagement to a degree, trying to understand at an early stage what is it that's affecting their circumstances and things like that. And, you know, we spoke about the customer journey. I think that can be built in to some of the customer journeys as well. So there are things going on.
Yeah. I mean, one of the challenges you often have in the industry in credit risk or in collections is sort of, you can sort of, you know, fall down the interest chain, I suppose, in terms of like, from a business point of view. I mean, it did feel like through the pandemic, we got pushed up given a lot more attention than we'd had historically. I mean, it feels like that's continuing. I mean, Andrea, we could think from your point of view, I mean, particularly in terms of the collections and in life cycle management, I mean, are people still getting the investment they need to sort of address some of the issues, almost like at a board level, and sort of the investment to look at new data and new collections journeys?
I think there has been a big shift. Like I said earlier, typically when you're looking at creditworthiness and in particular affordability, it's always been at that point of the decision for new lending. And like I say, that pendulum has shifted now to be looking at in-life affordability, and driven by the cost of living crisis plus consumer duty are both two real reasons why I think that has changed. So yes, I do think that there is more investment, there's more requests to us for data in that space, and there's more we're being asked for more consultative type help on the continuous monitoring of affordability across the customer life cycle. So I do think that investment is there and has changed, yeah.
And it sounds like we've got to sort of look much more at the pre-arrears piece. And there's a couple of questions that come here around, like, how is it best to sort of have those pre-arrears conversations? They can be quite difficult. And there's a question here around, you know, identifying customers with negative disposable income and those kind of things, almost like pre-collections to a certain extent, because we've got this creeping issue that we've talked about. Any kind of views on how we identify it, and then particularly when you get them on the phone or you get them, you know, you're engaging with them, what's the sort of view on how you engage people to almost like mitigate potential issues?
So from a data perspective, I think you've got to be really careful that you don't look at a single data point to try and understand whether someone's in financial health. I think there are multiple different data sources and evidence. So if you confront somebody with a single arrears or something, and you're going to contact them on that basis, then they quite easily refute that. But if you've got a lot of evidence from the data that you have, so you know that there's lots of key indicators, revolving debt utilisation, how they're paying, debt to income ratios, indebtedness levels, and it's a combination of all of those that are true indicators of someone's financial health. So you build up a view of an individual's financial situation, not just an I&E assessment. using modelled data. It's a number of different data points. And I do think, and I've spoken to some lenders, and they do feel that that conversation will be made easier because of the cost of living crisis, because it is spoken about, because people are aware of it, that actually that will make that conversation and that initial contact a bit easier. Because it is known to be a universal issue, right? So I think that will maybe open up those conversations with people entering financial difficulty.
Yeah, I mean, Anna, you got sort of any views on that in terms of like, particularly in terms, because it can be a tough conversation, like how to kind of broach it. I mean, I agree in terms of like, there's an environment that might actually help us.
Yeah, you're absolutely right. And we have these conversations quite a lot actually with our registered firms about customers don't want to be called out of the blue and told you are in financial difficulty or you're heading for financial difficulty, what are you going to do about it? So it comes back to having those effective conversations, which is a great statement, isn't it? But what does that actually look like? And so for a minute, I'll just talk about the environment, because that's a nice way of putting it, because I think that very often our approach is to deal with things as they happen, and it comes back to that proactive piece, because customers might not expect it. And so actually, education, awareness, and things like that are so important in spaces like this, because very often, and we know we've got this new cohort of customer that are going to fall into this space, they don't know the support that's available until they need the support, and there's some nervousness around having that conversation. So proactive engagement doesn't always have to be picking up the telephone and having that direct conversation with the customer. Or it can mean having a conversation or reaching out to them, but it can be talking about what is happening. As you've just said, we know that this is a universal piece, the cost of living crisis. We know that some of our customers are experiencing X, Y, and Z, so you're positioning it not like you have got this problem, but let's open that conversation. How's the cost of living impacting you at the moment? Because you start to build that rapport, don't you, and that you're putting customers at ease in the first instance, and then things will start to come out around that. Awareness, so we see some firms are looking at the strategy, that communication strategy, so not necessarily direct communication with the customer, but how can they have these subtle conversations? So that might be through where information is available on the website, it might be through general information updates to the customer that talk about how we've helped customers in these situations. We need to think about the positioning, the timing of communication, so conversations, again, information and awareness. I can use scams as a good example in this space, because that's at like pandemic levels as well, how many people are falling victim to a scam. Aftercare generally comes after somebody has fallen victim to a scam, but we saw some really great activity in the pandemic where firms were looking at which of my customers, through trend analysis, which of my customers are likely to be impacted by this, and then proactively contacting them with information. And so the same can be said in what's happening with the cost of living crisis, and using the data that Andrea spoke about to have those proactive reach outs.
So it sounds like very much like you're finding the reason for the conversation and trying to couch it into something that they can understand. And Chris, you wanted to comment?
Well, only to say that I think, you know, our sector, and again, it doesn't get commented upon or sort of recognised, but the level of customer engagement and interaction is many-fold more than you get between the debt advice sector and the customer. The debt advice sector is really important, absolutely crucial conversations, and signposting, I think, is working reasonably well in our sector between firms and where to go. But that bilateral interaction, in whatever form it takes, it gives our sector a really good insight into engagement. And I want to see maps, and I want to see the Treasury and government advertising and pushing the importance of picking up the phone, have a call, have the conversation, don't bury your head in the sand at the earliest possible opportunity. It's good to talk, all of those things. We run a sort of, here to help campaign, but we're too small to really get through to the public's awareness of, because there's so much fear of debt. And knowing now what I know about the sector, actually people don't need to be quite as frightened as they perceive that they are. Technology is amazing and is transforming our sector. I mean, I can't keep track of it. There's many more of you in the room who know about the latest offers that are available. And it's just so easy to have that dialogue and interaction. One thing I do think is a problem is that the regulators, I mean, obviously consumer duty is fine, principles-based is all the rest of it, but we've still got this really clunky, old-fashioned Consumer Credit Act framework with rigid requirements to send out notifications and letters in ridiculous 1974 language, these snozziers and snozziers, the statutory notices and all the rest of it, which are totally cut across the notion that you have helpful, flexible, tailored conversations with your customers. And it's bonkers to have this new consumer duty coming in that, but without simultaneously reforming some of that framework as well. Yeah. So if we're really going to help customers with their understanding, you have to do it holistically across the board. That's a big campaign point for us.
So you're talking a bit about almost like a branding issue to a certain extent around particularly the collections industry, because you've got to try to put much more of a positive message out there to a certain extent. It's like, can we do that? You also mentioned around debt advice, and there's also changes in the debt advice world that's going on in terms of like fundings and sort of as the SDRP coming up as well. Have we got too much going on at the same time? And do you think some of those impacts are going to sort of impact the sector as well, particularly the debt advice changes? There's a question here on that as well.
Yeah, a little bit too much.
Yeah.
In some respects, we've got, we don't know quite what's going to come out of the insolvency service review of those sort of solutions there, but we'll sort of see. This statutory debt repayment plan stuff is interesting because it was pushed, and now nobody really is sort of advocating. Everybody's a little bit critical about what's going on here. And there's a bit of a sense of initiative-itis when actually some of the existing solutions that are there, DMPs and others can be made to work relatively well. I would just like to see us get behind a sort of conversation with the population at large about don't be so frightened to talk about your indebted situation. Speak to your creditor, speak to your collections agency, have those conversations. Don't be so frightened about it, because it's every single news bulletin, every single analysis piece on the television, wherever, is the same sort of anecdotal vox pops and wherever. You hear it all the time, and it just feeds upon itself in a loop of fear that people are getting into, and I don't think it's very healthy.
Yeah. I know a lot of us have heard it for 20 years. But Faizan, just from from an industry trade body as well, it'd be kind of, what's your kind of view on that?
No, I agree with everything that's been said, and I think it's, particularly on the Consumer Credit Act, the FLA has been pushing for change of that for, as long as I've been at the FLA, which has been about 4 years or so now, and so it feels as though, it is the right time for that change. It can take several years or so, and as alluded to, there are so many provisions which are slightly outdated in that. So I think that change would offer that flexibility that you sort of referred to earlier on as well. So from our perspective, it can feel like there is a lot going on. I know we're still sort of awaiting things like the credit information market study, which I think was sort of at some it was meant to be published over the summer, and we haven't seen anything from it. But there's a lot going on. So. But with some of these things, I think they need to be prioritised, and I suppose some of the challenges with that is, I guess, when you have changes like we've seen over the last few months with government and all sorts, it makes it a little bit more challenging to approach the right sort of individuals and ensure that these initiatives are being sort of heard and sort of implemented. So I think there is a lot going on, but there is scope for the important ones.
A comment that was made to me was there's just so much going on, and particularly over the last sort of 6 months, even like politically and sort of like economically, it's almost like firms have sort of, we're all sitting here sort of like saying, well, let's wait and see to a certain extent. Do you think there's a bit of a sort of a rabbit in the headlights, or it sounds like we've got to get on with it? Andrea, I'm not sure if you've been hearing that, particularly around things like provisioning models. It's kind of like, how do you sort of put in, economic deterioration and factor that into provisioning models, those kind of things. It can change depending on, it might change this afternoon, depending on what we actually see. There's so much churn. How do we handle that in terms of is it back to that question of flexibility?
It's difficult, obviously. There is a lot going on. And obviously all of these things have to be prioritised, and at the moment, in all honesty, the key priority of most lenders is the cost of living crisis, followed very closely by consumer duty, because there's a bit of a lag. But what they're also looking at, I think, is looking to third parties as well to help them with some of that some of that stuff. So certainly where lenders currently have their own affordability processes, models, etc., they're looking at outsourcing that more because with the constant change, there is a need to constantly update. So, and they just don't have the technology or the resources to enable that to happen. So there are much more, I think organisations are much more open to getting help from partners, really, to help them through this. But yes, there's a lot going on, and it needs prioritisation.
Yeah, the other comment that's been made in terms of the cost of living, in terms of like, a couple of people have said, in terms of, are we talking ourselves into a recession? In terms of like, there's a lot being talked out on the radio, but that, and you hear that when you listen to calls, when you listen to customers, but yet we don't see it yet in the numbers. I mean, are we talking ourselves in? I mean, not that we can necessarily do that much about it, but do you think that's really a factor that's going on, or?
I just don't think that some of the expenditure elements have really hit individuals yet.
Yeah.
So, for example, I think I said earlier that when you're looking at mortgages, so there's 9 million plus mortgages in the UK, about a third of those are going to come off their fixed term within the next 12 months. And what that really means is say, somebody who's currently on a 2% fixed rate mortgage and now then has to find themselves remortgaging at 6%, that can be up to an extra £300 to £400 a month that they're having to find, right? So that hasn't really hit us yet. So I think there is a lot of fear-mongering. I do think we're talking ourselves up a little bit, but I really do think that some of these challenges haven't really hit individuals yet. On the other side, I think individuals are preparing for that. I agree with Chris that in my household, we're turning down the thermostats, we're looking at replacing old appliances with better energy efficient ones. You know, we're all doing our bit. So there is a behavioural element to this as well, that you know, people will tighten their belts. And is this becoming the new norm? Is this what we should really be doing? You know, we've been used to a great economic time for the last 10 years, really low interest rates. And actually, is this the new norm? And we're just going to have to adapt our behaviours and our spending appropriately. Yeah.
Anyone else on the panel want to comment, or Chris or Anna or Faizan?
Well, I mean, as we've sort of said before, I mean, you know, the statistic that hit me about the remortgage, is that currently, typically, 17% of income is on the sort of mortgage, and that's predicted to go to 27% share of an individual's income on their mortgage. I mean, that you know, squeezes other stuff out. The degree to which, you know, other expenditure is truly discretionary or necessary is a bit moot, and everybody will have their own sort of opinions. But it's definitely going to have it's the lag effect and how it comes through, and it will be much more middle income households
Absolutely.
now. It's not just going to be the very most poor, the poorest and the most vulnerable. It is going to extend itself right up the scale. But having said that, we do have a very particularly British habit sometimes of talking ourselves into a little bit of a frenzy on some of these things. And there are some, you know, shafts of light that you could potentially see. And, you know, you never really know what's around the corner. I mean, obviously, there are some structural issues, particularly Ukraine and Putin and all these other things. But again, you don't really know what's going to happen on some of those fronts. So we'll just have to sort of see.
I mean, we tend to, particularly the media, tends to be sort of like, it's always either terrible or it's great. We're on this like binary positions, but in fact there's an awful lot of grey in between, and it feels like some of this stuff is just, we're just waiting to see how it sort of feeds through our process, and it's probably take a little bit longer than we thought. So we're almost at time, you know, and I did ask some questions from the slide. I don't know if there's any burning questions that anyone wants to ask live before I ask for final comments in the audience. Or thanks for the questions that come through. I hope we try to get through some of them. So just before we end, I suppose, what do you think the biggest challenge is going to be over the next year, just in sort of one sentence before we finish? We'll just go down the road in terms of, Anna, do you want to go first? Biggest challenge we've got to be focused on if you're looking at your clients, customers, members, you know, what have we got to be focused on?
The ability to act with speed and agility. So agility, would be my key takeaway for people.
Chris?
I think persuading the customers to have conversations and understanding that there is, communicating that there is forbearance that is available, but only if you have that dialogue. And somehow we've got to get people into that dialogue in the first place.
Yeah.
But that's a big marketing comms.
Yeah. There's a good plug for engaging customers, which is the next one, right? So we'll be onto that. Good. Thank you. Andrea?
For me, I think it's the identification of people who are truly in financial difficulty and prioritising effort and response to those. So, early warning indicators, identification of people who are entering financial difficulties.
Faizan?
Yeah, I would agree. I mean, I think I alluded to the low financial resilience earlier on, and I think that is something which is, in the regulator's view, only going to sort of increase. So I think that's one to watch out for as an emerging risk. And I think the other thing is this consumer duty, as we've sort of touched on. So this is going to be probably something that firms will focus on a lot next year as well.
Okay. Well, fantastic. Well, Chris, Anna, Andrea and Faizan, thank you very much for being on the panel today. It's fantastic. It's fascinating. I think we're just in a massively changing time, and we're constantly trying to keep up with it. But it does sound like we've got to be on it now because of what might happen rather than necessarily seeing it today. So thank you. Just a round of applause for the speakers. Thank you very much.